Chapter 18 Openness in Goods and Financial Markets. Chapter 18 discusses the implications of openness in goods and financial markets. Openness in goods markets allows people to choose between domestic goods and foreign goods. An important determination of their decision is the real exchange rate, the relative price of domestic goods in terms of foreign goods. Openness in financial markets allows people to choose between domestic assets and foreign assets. This implies a tight relation between the exchange rate, both current and expected, and domestic and foreign interest rates, a relation known as the interest parity condition. Learning objectives. Define the nominal exchange rate and explain what is meant by a depreciation and appreciation of the domestic currency. Define the real exchange rate and explain the determinants of the real exchange rate. Explain what the balance of payments, current account, and the capital account measure. Know the distinction between GDP and GNP. Learning objectives. Explain what factors influence an individual's decision to hold domestic versus foreign bonds. Figure 18-1 shows the implications of openness in the goods and financial markets. The financial crisis started in the United States, but it affected nearly all countries in the world. Figure 18-2 shows U.S. exports and imports as ratios of GDP since 1960. The figure suggests two main conclusions. 1. U.S. economy is becoming more open over time. Share of exports and imports as ratios of GDP have gone up from 5% to 14.5%. This represents average of ratios of exports and imports to GDP. 2. U.S. has consistently run a trade deficit since the 1980s. Table 18-1 shows ratio of exports to GDP for selected OECD countries. U.S. has the lowest ratio, Belgium and Netherlands have the highest. This does not mean that the U.S. has more trade barriers than Belgium or the Netherlands. Two main factors behind these differences are geography and size. The smaller the country, the more it must specialize on producing and exporting only a few products and rely on imports for other products. Figure 18-3 shows the nominal exchange rate between the dollar and the pound since 1971. Nominal exchange rate can be quoted as the price of domestic currency in terms of foreign currency, say pounds per dollar, or the price of foreign currency in terms of domestic currency, such as dollars per pound. The textbook consistently uses the first definition, and the nominal exchange rate is denoted by E. E is therefore expressed as pounds per dollar or yen per dollar, that is, price of the domestic currency in terms of foreign currency. Appreciation of the domestic currency is an increase in the price of domestic currency in terms of foreign currency. Thus, it corresponds to an increase in the exchange rate. Depreciation means a decrease in the exchange rate. In figure 18-3, you can see two things. 1. Trend increase in the exchange rate. Dollar increased from 0.41 pounds in 1971 to 0.61 pounds. There was appreciation of the dollar relative to the pound. 2. Large fluctuations in the exchange rates. Dollar appreciated sharply in the first half of the 1980s and then depreciated sharply in the second half. Figure 18-4 shows construction of the real exchange rate, which gives the price of U.S. goods in terms of UK goods. Suppose a dress shirt costs $50 in the U.S. Using the nominal exchange rate E, we can convert this to price in pounds. Suppose E equals 0.50, that is, half pound is equal to $1. Then E times P gives us the price of the dress shirt in pounds, or $50 times 0.50 equals 25 pounds. Now, if a similar dress shirt in the UK costs 50 pounds, then the price of US dress shirt in terms of UK goods is 25 pounds divided by 50 pounds, or half. Important formula to know is that real exchange rate epsilon is equal to E times P divided by P star, where P is given by the GDP deflator for the US as an indicator of the price level in the US, and P star is the GDP deflator for the UK as an indicator of the price level in the UK. Equation 18.1 repeats the formula for the real exchange rate epsilon. Epsilon equals E times P divided by P star, where P is given by the GDP deflator for the US as an indicator of the price level in the US, and P star is the GDP deflator for the UK as an indicator of the price level in the UK. Behavior of real exchange rates depends on the behavior of two terms, the nominal exchange rate E and the ratio of prices in the two countries, P over P star. Real appreciation refers to increase in the price of domestic goods in terms of foreign goods. In this case, real exchange rate epsilon increases. Real depreciation refers to decrease in the price of domestic goods in terms of foreign goods. In this case, real exchange rate epsilon decreases. Figure 18-5 shows that since the 1980, the nominal and real exchange rates have moved together. However, from 1971 to 1975, the nominal exchange rate rose, but the real exchange rate fell. Dollar became stronger, but because of a more rapid increase in the price level in the UK, P over P star fell by more than the increase in E, causing real exchange rate epsilon to fall. With a stronger dollar, you would think it would be cheaper to vacation in the UK, but because the real exchange rate fell, the trip will be more expensive. The dollar buys more pounds, but since prices rose faster in the UK than in the US, real exchange rate fell, making US goods cheaper in terms of UK goods, or UK goods more expensive, and thus the trip more expensive. Table 18-2 shows the major trading partners of the US. This represents three sets of countries: our neighbors Canada and Mexico, the European Union, and the eastern nations of China and Japan. A country's transactions with the rest of the world, including both trade flows and financial flows, are summarized by a set of accounts called the balance of payments. Table 18-3 shows the balance of payments for the United States for 2010. The table has two parts separated by a line. The transactions above the line record payments to and from the rest of the world. They are called current account transactions. These represent the sum of three transactions: trade balance, net income, and net transfers received. 1. Exports lead to payments from the rest of the world. Imports to payments to the rest of the world. Difference between exports and imports is the trade balance. In 2010, imports exceeded exports, leading to a US trade deficit of $500 billion. 2. US residents receive income on their holdings of foreign assets, and foreign residents receive income from their holdings of US assets. In 2010, net income balance was $165 billion. 3. Finally, countries give and receive foreign aid. In 2010, net transfers received for the US was negative $136 billion, reflecting the fact that US gives more aid than it receives. The sum of the payments to and from the rest of the world is called the current account balance. In 2010, the US ran a current account deficit of $471 billion, which is the sum of negative 500 plus 165 minus 136, roughly 3.2% of its GDP. The capital account. The fact that the US had a current account deficit of $471 billion in 2010 implies that it had to borrow $471 billion from the rest of the world, or equivalently, that net foreign holdings of US assets had to increase by $471 billion. The numbers below the line indicate how this was achieved. Transactions below the line are called capital account transactions. You can see that foreign private investors, foreign governments, or foreign central banks bought $1,260 billion worth of US stocks, bonds, or other US assets. Increase in US holdings of foreign assets was $1,005 billion. The result was an increase in net US foreign indebtedness, also called net capital flows to the US, of $1,260 minus $1,005 equals $255 billion. Another name for net capital inflows is capital account balance. Positive net capital flows are called capital account surplus. Negative net capital flows are called a capital account deficit. In 2010, US had a capital account surplus of $255 billion. A country that runs a current account deficit must finance it through positive net capital flows. Equivalently, it must run a capital account surplus. In principle, capital account surplus must be exactly equal to the current account deficit. But because they are constructed from different sources, they are not equal. The difference, $216 billion, is called the statistical discrepancy. Table 1 shows GDP, GNP, and net income (NI) numbers for Kuwait from 1989 to 1994. GNP equals GDP plus NI. For most countries, the measures GDP and GNP are very close. Kuwait earns a lot of income from abroad because of income earned from oil that it has invested abroad. Thus, GNP is greater than GDP. Openness in financial markets means people can invest in US bonds or foreign bonds. Figure 18-7 shows expected returns from holding 1-year US bonds versus 1-year UK bonds. The return earned on the foreign bond depends not only on the foreign interest rate I star, but also on the expected exchange rate 1 year from now. Assuming that people want to hold the asset with the highest expected rate of return, if both US and UK bonds are to be held, they must have the same expected rate of return. Equation 18.2 shows us this condition. It is called the uncovered interest parity relation, or simply the interest parity condition. Small movements in interest rates and rumors about impending appreciation or depreciation can lead to movements of billions of dollars within minutes. Equation 18.4 is the one to remember. It says arbitrage by investors implies that domestic interest rate must be equal to the foreign interest rate minus the expected appreciation rate of the domestic currency, or the domestic interest rate must be equal to the foreign interest rate minus the expected depreciation rate of the foreign currency. Suppose the domestic interest rate is 5% and the foreign interest rate is 6%. Then invest in US bonds if expected appreciation of domestic currency is more than 1%. Invest in foreign bonds if expected appreciation is less than 1%. Figure 18-8 shows the 3-month nominal interest rates in the US and UK since 1970. They have largely moved together over the last 40 years. If interest rates are lower in the US by 1% than the UK and the interest parity condition holds, it must be that financial investors expect the dollar to appreciate by 1%, and this is why they are willing to hold US bonds despite their lower rate. The interest parity condition suggests that unless countries are willing to tolerate large fluctuations in their exchange rate, domestic and foreign interest rates are likely to move together, as shown by figure 18-8. In countries that have fixed exchange rates, the arbitrage condition implies that expected depreciation is zero. So the interest rates in those countries have to be exactly equal. Domestic interest rate I is equal to the foreign interest rate I star.